Good morning. It's Monday, April 6th, and this is episode 1. With me, as always, Tom, who covers tech and the growth names, AI, semis, mega cap earnings, and Ray, who watches the Fed and everything underneath the market numbers, rates, macro, the data nobody reads until it matters. I'm Alex. I host, I pull prices on demand, and I have 3 sound files I still haven't listened to. Long weekend in the books, market had 3 days off, and it came back to find oil up 11%, Tesla down 5%, the AI names quietly firm, and FOMC minutes plus CPI both queued up for later this week. Let's get into it.
Yeah, it's Tom. I watch the shiny stuff. AI, semis, anything priced for perfection and behaving like it believes it. The weird bit is we've got oil screaming higher in tech, just calmly bidding anyway. That's not how this usually works. You're basically being told inflation might reaccelerate and the market's like, yeah, but have you considered GPUs? If that holds, it's not a rotation, it's a belief system. And those only break all at once.
And I'm Ray. I'm the guy who gets excited about revisions to labor data and wonders why the Fed's dot plot usually looks like a Rorschach test. I still think starting a podcast where we record our bad takes for posterity was a mistake, but here we are anyway. Looking at oil jumping 11% over the break while the market just shrugs and buys more chips. It's wild to me. We've got CPI and PPI at the end of the week, and if energy stays this angry, those rate cut dreams are going to start feeling like a long-distance relationship that isn't working out.
Right. One thing before we get into it. Episode 0, I said we'd each recorded a 5-second instrument clip for the section breaks. I have all 3 files. I have listened to exactly one of them, mine. I genuinely have no idea what Tom and Ray submitted. I will say this, 2 of the files are around 5 seconds. One of them is not. Someone got carried away. You'll all find out at the same time I do.
There's a difference between a clip and a statement. If something has a beginning, middle, and a respectful fade, I don't think we should punish that just because it refuses to be 5 seconds long. Feels a bit anti-art.
Oh, Tom, calling it a statement already? You are so guilty it's actually impressive. You're basically pleading the 5th while admitting everything. I just hope this artistic vision doesn't take up the entire pre-market session.
We'll all find out together. All right, oil, Tesla, chips, and a week with CPI on Friday. The tape is up next. Back in 5.
That's confident. That's a man who believes brass can solve most problems, which, to be fair, is how the Fed operates.
Alex, I didn't know we were being summoned to battle. It actually fits, though. Nothing says soft landing quite like a loud horn and a lot of hope.
The trumpet is aspirational. I stand by it. All right, the tape. Thursday was one of the weirdest flat days I've seen in a while. SPY up 1/10, QQQ up 1/10. Looks like nothing happened. Except oil ripped 11%, Tesla fell 5.5%, gold dumped 2%, and AMD was up 3.5%. All on the same day. The market was running 3 separate narratives simultaneously and somehow landed green. Tom, AI held, chips held. NVDA, MSFT, AMD all firm while oil was signaling inflation might be back. How is tech not flinching?
Because the market's just decided oil is someone else's problem. It's treating that spike like a supply hiccup, not a regime change, so it's not repricing the terminal rate off one violent move in crude. Meanwhile, AI names are sitting there with actual revenue acceleration, so you've got this weird split where inflation risk is theoretical, but AI demand is showing up in numbers. And if you believe rates are still drifting lower into the back half of the year, you buy duration early, which is basically just buying NVDA and hoping the Fed reads the same slide deck. If oil stays bid for more than a week, this gets awkward very quickly.
Tom, someone else's problem is a bold strategy when that someone else is the guy who sets your interest rates. The Fed is looking at that 11% jump in oil and then looking at Friday's CPI print and, well, they aren't exactly doing a victory lap in the footnotes of their own projections. We have the whole inflation trilogy hitting this week with the PCE revisions and then CPI and PPI, And if those numbers don't behave while energy is reflating, that rates are going down narrative is going to get a very cold bucket of water dumped on it.
The 10-year, last Fed reading had it at 4.35. That's where it was sitting. And if oil keeps going and that starts walking toward 4.6, the AI is immune to rates argument gets tested very quickly. The other thing I want to get into, gold. Oil rips 11%, classic inflation hedge, and gold fell almost 2% on the same day. Someone isn't hedging the right thing. Tom, what does gold dumping on an oil spike actually tell us?
It's not a contradiction, it's just two different stories pretending to be the same thing. Oil's up on supply risk. That's inflationary in headlines. But gold trades real yields. And if the market thinks the Fed has to stay tighter because of that oil, yields go up and gold gets hit. So you've basically got inflation is back in crude and rates stay higher in gold, which is a slightly worse combination than people are pricing.
That's the combination nobody wants to say out loud. All right, Tesla, down 5.5%. That's the delivery miss verdict. Q1 numbers came in soft and the market just said, fine, we're treating you like a car company now. And because Tesla is the biggest weight in consumer discretionary, it dragged XLY down 1.5% while the rest of the tape was green. So you had AI winners, a rate-sensitive bounce in REITs, and then Tesla quietly bleeding in the corner. Tom, idiosyncratic, or is it the canary?
It's mostly Tesla, which is a sentence people keep saying right before it isn't. The deliveries were soft, pricing's getting weird, margins are doing that slow leak thing. That's company-specific. But if gas is ripping and the most aspirational purchase in the index is wobbling, that's not a great background signal for the consumer either. It's idiosyncratic, with a slightly ominous aftertaste.
It's like we're all collectively staring at the shiny AI chips, so we don't have to look at the gas station signs or that Tesla drop. Well, seeing gold tank while oil goes vertical tells me the market is betting on a growth story that doesn't mind a little heat. Even if the Fed's plan to keep things cool is getting a lot harder to justify with every barrel of crude.
That's the tape. Ray, the footnotes are yours. Back in 5.
That's not footnotes. That's a Victorian ghost announcing inflation is back.
I mean, it fits. All right, Ray, the footnotes. What's underneath Thursday?
Well, if the ghost has the Fred password, I'm listening. But seriously, seeing REITs and utilities lead the pack while oil puts up a double-digit gain is just, it's classic head-scratching macro. Usually, that kind of energy move is a neon sign for higher for longer. But the market is acting like it's a one-off supply glitch instead of a trend. I'm looking at gold dumping 2%, and it feels like the big money is bracing for real yields to climb, even if the equity guys are still whistling past the graveyard. We're heading into this inflation trilogy starting Thursday, PCE, CPI, and PPI all in about 48 hours. And the Fed minutes on Wednesday are going to show us exactly how worried they were before oil started acting out. If those inflation prints don't show some serious cooling, that 4.35% on the 10-year is going to start looking like a floor rather than a ceiling. Alex, can you pull the 10-year at, I don't know, around when that Fed comment landed?
Yeah, the 10-year. Last Fed reading had it at 4.35. That's the number heading into this week.
435 is comfortable, which is usually when it isn't. The minutes are basically a time capsule from before oil decided to do an impression of a problem. So what you're really reading is how confident they were when things looked tidy. If that tone is even slightly uneasy, the market's going to realize they were closer to not done than cutting soon. And if core PCE prints 0.4 or higher into that, you've got yields treating 4.35 like a warm-up, not a ceiling. And suddenly all this buy-duration early stuff in tech and REITs starts to look a bit premature. Which is fine, as long as nothing else goes wrong.
As long as nothing else goes wrong, famous last words. Ray, the REITs bid, XLRE up 161 on a day oil ripped 11%. That doesn't make sense on the surface. What's the bet being placed there?
It really is a don't look at the man behind the curtain situation, isn't it? I think what we're seeing is just a massive wave of fresh Q2 money being forced into the most beaten-down sectors, where investors are betting that the eventual rate cuts are more certain than whatever is happening at the gas pump. But Tom hit the nail on the head. Gold dumping tells us the bond market is actually bracing for a fight. And if those CPI numbers on Friday don't cooperate, all this smart rotation into real estate is going to look like a massive, unforced error. We're basically watching a game of chicken between equity bulls who want to believe the landing is soft and the commodity signals that are screaming about a reflationary headache.
That's the cleanest summary of this week's setup I've heard. Ray, close it out. What's the one thing the market is most wrong about right now?
I think the market is most wrong about the idea that the Fed is still the one in control of the calendar. We're all sitting here counting down to a cut, but if oil keeps this up, the inflation floor isn't 2% anymore. Well, it's 3%. We're buying duration as if the fire is out, but the commodity tape is telling us the basement is still very much smoldering.
Smoldering basement. Perfect image for a Monday morning. That's the footnotes. Tom, Nerd Corner is yours. Back in 5.
Tom, I thought you were kidding about the pipes. Are we about to lay siege to the FOMC or what? I mean, nothing says technical analysis quite like a Highland war cry.
I maintain they're appropriate. Tom, Nerd Corner, dig in.
If the Fed starts communicating in bagpipes, yields go straight to 5. Anyway, AMD up 3.5 wasn't random. That's MI 300X backlog talk creeping into price. Hyperscalers still short on inference capacity, so anything that ships now gets treated like oxygen. Nvidia only up 1%, which is funny, because nothing about their demand has slowed. It just means people are rotating into what's next without actually leaving the king. Microsoft up another one. Azure is basically turning into a power utility for AI. CapEx goes in, tokens come out. Nobody's really sure where the ceiling is, so they just keep raising it. The technical read is simple. Dips are getting bought faster, and leadership is narrowing back to chips plus the platforms that can actually deploy them. That's not broad risk on, that's very specific conviction. Ray, where do you think the next leg of demand actually comes from? Is it enterprise co-pilots finally showing up in revenue, or are we still just feeding the hyperscaler training inference loop? Because right now, it still looks like 3 companies selling to 4 companies and calling it an ecosystem.
Tom, 3 companies selling to 4 companies is basically the entire S&P 500 at this point, isn't it? But looking at the flows, I think we're underestimating the sovereign AI side of the house. You've got entire governments looking at their balance sheets and deciding they can't leave their compute destiny to a handful of guys in Redmond or Santa Clara. That's a different kind of demand because it's not as sensitive to the Fed funds rate. Well, if a nation-state decides they need a sovereign cloud, they're going to build it whether the 10-year is at 4% or 5%. It turns this from a cyclical tech trade into something that looks more like national infrastructure spending, which keeps that CapEx floor a lot higher than the higher-for-longer crowd wants to admit.
Sovereign AI. That's an angle we don't hear enough. Tom, pull the thread on Tesla before we close. The delivery miss. Is there a technical level or a fundamental catalyst that actually matters here?
Yeah, the chart's pretty simple. $350 is where people pretend it's fine. Lose that with conviction, and you're looking at $300 where the last real buyers showed up. The problem is it's not a chart story first. It's margins. Price cuts are doing the work deliveries used to do, and that's a worse business every time you repeat it. What fixes it is either a genuine demand unlock, new model that actually expands the TAM, not just reshuffles it, or something real on software revenue so they're not selling hardware at a discount and calling it strategy. Until then, it's a very expensive car company discovering gravity in slow motion.
Discovering gravity in slow motion. That's the line. All right, that's Nerd Corner. The calls are up next. Back in 5. All right, the calls. NASDAQ futures up almost 0.5%. S&P up 0.25%. Market wants to open green. Tom, does the AI bid hold today, or is this the week it gets tested?
If the NASDAQ's up 0.5% and AMD immediately adds to that 3.5% from Thursday, while Nvidia pushes through pre-market instead of stalling, it's real. If they both pop and then just sit there while yields tick up, that's positioning getting unwound in real time. First hour tells you everything. Either chips lead again, or they get sold into like people remembered CPI exists.
Ray, FOMC minutes drop Wednesday. Trade around it or sit on your hands?
Well, if you're sitting on your hands, at least you aren't clicking buy on a head fake. I'm definitely sitting tight because the minutes are where you see if the hawks were actually screaming behind closed doors about those sticky service costs, while the energy market was starting to simmer.
Fred had the 10-year at 4.35 going into the weekend. If it walks toward 450 post-minutes, that's the tell. Tom, Tesla today. You said 350 is the line. Open below it or hold?
It tests it. There's just too many people staring at the same number. You can feel it. It opens weak, drifts, tags 350 late morning, and then you get the world's most unconvincing bounce. If it actually breaks and stays below, that's not a dip. That's people quietly giving up on the quarter.
Ray, close it out. CPI Friday. What number breaks the cuts are coming story completely?
If that core month-over-month prints at 0.4, the summer cut dream isn't just delayed, it's dead, Alex. You combine that with oil ripping 11%, and the Fed's disinflation narrative just hits a total brick wall. They'd have to keep those rates parked in the garage until something actually breaks.
Rates parked in the garage, and meanwhile the market's standing in the driveway pretending it's warming up. All right, that's the calls. That's episode 1. Thanks for riding it out with us. We'll be back tomorrow, same time, same 3 idiots. Take care of yourselves out there.